Welcome to The Explainer. Today, grab your equity analyst hats because we're rolling up our sleeves to do a rigorous, no-nonsense valuation of Novanta, and we're basing this strictly on the company's latest financial metrics. If you followed the industrial sector, you already know Novanta has been generating a lot of buzz. But hey, as analysts, we don't buy into the hype, right? We look at the math. So we're going to completely strip away the market noise and stress test this valuation to see what the intrinsic value of this business actually is.
All right, let's just jump straight into the current market claim. Right now, Novanta stock is sitting at $126.08 a share. That effectively slaps a market cap of around $4.5 billion on the company. That's the exact price tag the market is asking you to pay today.
But here's the multi-billion-dollar question. Is that price actually justified by the hard fundamentals, or is the market, frankly, hallucinating? Our entire job today is to interrogate that $126.08 figure. We need to calculate the stock's intrinsic value and find out if the underlying financial reality, the cash flows, the earnings, the balance sheet, actually backs it up.
To get to the bottom of this impartially, we'll run through a four-part framework: absolute valuation, relative multiples, an asset-based analysis, and an intrinsic value synthesis.
Starting with Phase 1, absolute valuation. Let's test that intrinsic cash-generating power. You know the drill here. The discounted cash flow, or DCF model, is our gold standard. The logic is totally straightforward. A company is really only worth the total free cash flow it can generate in the future, discounted back to today's dollars. So we project out those future free cash flows, apply a risk-adjusted weighted average cost of capital, our WACC, as the discount rate, and boom, we calculate exactly what that cash pipeline is worth right now.
Well, when we actually run those models using the source data, we immediately hit a massive, glaring gap. The intrinsic value based on free cash flow comes in at just $66.82. And if we pivot and run it using earnings per share, it drops down even further to $44.33. Now, put that next to the current trading price of $126.08. That is a wild disconnect. The market is pricing in a reality that these absolute cash flows absolutely do not reflect.
Now, usually, we'd also cross-reference this with the dividend discount model to find the present value of expected future dividends. But checking the data, we actually have to scrap the DDM entirely. Novanta has a 0% dividend compound annual growth rate. They literally don't pay one, so there's nothing to discount. We are 100% reliant on the company's internal cash generation and earnings.
And honestly, this right here explains why those DCF numbers look so brutal. Over the last 5 years, Novanta's earnings per share did grow a bit, hitting a 5.01% annualized rate. But look at the free cash flow. It has a 5-year compound annual growth rate of negative 17.87%. And over the trailing 12 months, it's plummeted by over 65%. When your cash flow is collapsing like that, any DCF model is going to heavily penalize your intrinsic value. The math just won't let you model a rosy future when the current cash pipeline is drying up. Moving on to Phase 2, relative valuation. Time for a market reality check. As we all know, the price-to-earnings, or PE ratio, is our go-to here. It tells you exactly how much of a premium you're coughing up. It's literally the dollar amount you have to shell out today just to buy $1 of the company's current profit. Get this. Novanta is rocking a staggering trailing PE of 86.36. Think about what that actually means. You're paying over $86 for every single dollar of profit they generated last year. Now, the data does show a forward PE of 8.39, which implies analysts are banking on an absolute explosion in future earnings to bring that multiple down to earth. But based on what they've actually delivered lately, that premium is astronomical. It requires almost flawless future execution to ever make sense of it. Flipping over to enterprise multiples, which factor in debt and cash for a true total company value, the story doesn't really get any better. The EV to EBITDA sits at 24.26, and EV to EBIT is all the way up at 37.14. Even though our source documents don't name specific peers for a direct side-by-side, we can use standard industrial baselines. Your typical mature industrial peer is usually trading closer to, say, 10 or 15 times EV to EBITDA. So a multiple north of 24, that shows the market has baked a massive premium into Novanta's current price. Phase 3, asset-based valuation. Let's break down the balance sheet. Quick heads up on our modeling assumptions here. Because the source files didn't give us the explicit line item totals for total assets and liabilities, we're relying directly on the provided financial ratios to infer their balance sheet health.
We're also slotting in a standard terminal growth rate of 2 to 3% to cover any long-term gaps in the data.
The good news? The ratios we do have show some seriously rock-solid liquidity. The debt-to-equity is incredibly low at just 0.19. Their current ratio is 3.69, meaning they've got nearly 4 times as many current assets as current liabilities. Even the quick ratio, stripping out inventory, is super healthy at 2.80. This proves Novanta is highly liquid with hardly any debt leverage. That's a huge plus. If things get bumpy, they have the balance sheet to weather the storm.
But, of course, that balance sheet strength is already totally priced in. Since we don't have the raw totals to calculate an exact net asset value per share, we look at the enterprise value to assets ratio. At 2.40, the market is valuing this company at nearly 2.5 times the value of its actual, physical, and intangible assets. So you definitely aren't getting a discount on the parts here. You're paying a very hefty premium for the operations built on top of those assets.
Finally, Phase 4. Synthesis. Let's get to our final verdict.
We couldn't really run a residual income model due to the specific data constraints, but stacking up what we do have, the math is pretty undeniable. The intrinsic models just cannot reach the current market price. We've got $66.82 on the generous cash flow side and $44.33 on the earnings side, up against a market price of $126.08. That is a gaping chasm between what the math says the company's worth and what the stock market is actually charging you to buy it.
To be completely fair, let's weigh the reliability of what we're looking at. In the pro column, Novanta has incredibly high liquidity, and historically, it does consistently command a premium multiple. But the glaring red flag is that collapsing free cash flow. A trailing 12-month drop of nearly 66% heavily skews those absolute valuation models to the downside. And yes, we're relying on the source's pre-calculated fair values, but honestly, with cash flow deteriorating this fast, any sensible DCF model is going to ring the exact same alarm bells.
So what's the bottom line? The models point to severe overvaluation based on the current cash flows. Unless Novanta can suddenly trigger unprecedented, explosive hypergrowth to reverse that cash flow decline and somehow justify an 86 trailing PE, this stock is currently vastly overvalued.
Actually, look at this. The source documentation leaves us with this staggering takeaway: a margin of safety of negative 88.68%. If you're a value investor, you know you need a positive margin of safety to protect your downside. Negative 88% means there is literally zero room for error. Buying at today's price means you are entirely banking on market optimism rather than mathematical value. So it all leaves us with one massive question to ponder. If $126 is mathematically way too high, at what price does this highly liquid, low-debt company finally become a smart buy? You're going to want to keep a very close eye on those free cash flow metrics in their next quarter, because until that cash engine restarts, intrinsic value is not catching up to that stock price. Thanks for hanging out with me for this explainer, and keep thinking critically out there.